If you are 45 years old and looking at a retirement income with a zero balance and wondering if you're too late, I need you to take a deep breath. You are not too late.
You just need a different plan.
Today we're going to be sharing with you how you, starting at nothing at the age of 45, can build a retirement income by the age of 65 with investing $35 a month. Let's get into it.
First, you have to find some extra cash.
Exactly, Henry. The bottom line is that you have to be able to find some money. There is money to be found. It can be hard. I'm not saying it's not. But you might want to call your credit card companies and see if they can lower the interest rate. You might want to see if you can sell off of Facebook Marketplace or have a yard sale. One thing my husband and I did was when we were trying to get ourselves out of debt, we created a budget on how much we could spend at the grocery store. And when we went to the grocery store, we had to stay in that budget. Make saving money a game. So the first goal is finding that $35 a month and earmarking it for your future.
Next, build a cash buffer.
Now, before you invest, you have to start with an emergency fund. You have to build that first, because what happens if you don't have that emergency fund and something arises that you were not planning, unexpected bill or car broke down, then if you don't have that emergency fund, then you go right back to your credit card, put the bill on there, and you're starting all over again. So you want to be able to have some cash on hand for those unexpected surprises. Now, when you do open up your emergency fund, you want to open with a high yield savings account with a 3% interest. So as you're putting money in, you are starting to build some extra money. Now, you want to reach at least $1,000 in that emergency fund before you do anything else. Now, let's look at the math. You have now opened a high yield savings account starting with $35 a month at 3% interest, and your goal is to reach $1,000. It's going to take you about 28 months to do that. So out of pocket, you are putting in $980, and the interest is going to push you past that $1,000 goal. Now, it might sound small, but it is a huge psychological victory. Just knowing that you have that money in case an emergency happens, albeit a small emergency, but something, just makes you feel a little bit more relaxed, more free. Now, once you reach that $1,000, then you want to start to attack your credit card bills if you have them. I'm not a financial advisor, but this is what we did, was I tackled the small ones first. And the reason I did that was more for that, again, psychological effect, going, I am chipping away. Where if you go with a high one, it just takes you so much longer. You don't build that momentum. You don't see it as fast. So I always say go with a low one, pay that off, and then put that extra little money into the higher ones. And then you start to slowly build those. The biggest thing is trying to get away from using the credit card until they're paid off, and then learn how to use them.
At age 47 and a half, we pivot.
Okay, now that you're at 47 and a half, because you already spent about 28 months to put together your emergency fund and start paying a little bit off your debt, now we're going to pivot and we're going to start working with the stock market. And because we are late investors, we're going to do the 40-40-20 split. All right, now you're at age 47 and a half. You've already built up at least a little over $1,000 in your emergency fund. You're starting to chip away at the credit card debt. Now you're going to be opening up a Roth IRA. It has to be a Roth IRA. And you're not going to stop putting money into your emergency fund. You're still going to. You're going to give $15 there, but now you're going to be starting to put money into your Roth IRA to build up your retirement income through that. Now, the reason it's going to be a Roth IRA is because you already paid taxes on it. So when you put the money into your Roth IRA, all the money that you're earning from dividends on that, no taxes. Every dollar that you put into that is going straight into your portfolio. Okay, so $15 is still going to continue to go to your emergency fund.
Here is how you split the $20.
And now you're going to take $20 to put into your Roth IRA. Now, I am using certain ETFs as models, but that's exactly what they are. They're just models to show you what can happen. When you do decide to start investing, please do your own due diligence. Find out what works for you. Talk with a financial advisor, whatever you feel comfortable with. But you want to look for the high yield ETFs and stocks. So now you have that $20. You're finding your high yield stocks and ETFs, and you're going to do a 40-40-20 split. 40% is your cash flow, 40% is your growth, 20% is your miscellaneous. All right, so here is a model. $8 goes to SPYI. This is your 40% cash flow. It's an S&P 500 high income ETF yielding around 12%. $8 goes to QQQI. This is 40% growth. It's a NASDAQ high income ETF yielding around 14%. Now, just a reminder, this is to build some growth, but still heavily focused on building cash flow. QQQI utilizes a flexible call option strategy, which allows investors to capture some equity appreciation. $4 to VTI. This is your miscellaneous. It's the total stock market, which grounds and stabilizes your portfolio.
But what about NAV decay?
I'm glad you brought that up, Henry. That is a real concern, especially if you're doing your research on high yield ETFs and stocks like SPYI or QQQI, is the risk of NAV decay. And NAV decay just means that the share price will slowly go down due to the high dividend payout. Now, NAV decay is a real risk if you buy the share or stock and then you just walk away. But we offset that NAV decay by doing two things. First, you are consistently adding money to your position weekly, monthly, whatever you decide. Right now with this scenario, it's $20 a month. And then that will, of course, buy some more shares. Second, you're going to reinvest all your dividends, and this will allow you to buy more shares. You are constantly building your shares to outpace any share price drop.
Let's look at the math.
Now let's look at this from age 47 and a half to age 65, how much you have grown in your cash flow. If you invest just $20 a month into this exact split, assuming a conservative blend return of 11%, you will have put in just $4,200 of your own money, but because of compound interest, your account grows over to $12,600. You just tripled your money. Now just imagine if you are able to pay off your debt and change that from $20 a month to $200 a month. Let's look and see how that would impact you. That $200 a month, that turns from $12,600 into over $126,000. Now, as you get closer to retirement, protecting your money is just as important as growing your money. So you want to work on your health right now. You want to be able to keep your medical costs down as low as possible, and also those high premium insurance rates, which will save you thousands of dollars. Also, look at your housing. If you're fortunate enough to downsize, definitely do that. My husband and I have actually looked into that, and for us, it's not feasible. We have a pretty low mortgage. But what we are doing is we are looking at, when it is time to retire, maybe looking outside of the United States where it is a lower cost of living. And what we are hoping is to find something that has free public transportation or it's walkable, so that way we can get rid of our vehicles altogether, and then that will save us thousands of dollars right there.
Start small and stay consistent.
Now, after you have your emergency fund, you're feeling good, you're in the stock market, you're making your investments, you're hopefully adding more money to your position to grow it even more, then I definitely recommend getting another high yield savings account that is considered more of your regular savings account. So that way it would take the place of what your emergency fund is doing right now. So that way your emergency fund becomes truly what it is, an emergency fund. For a really high expense comes up, like you lost your job or someone got seriously hurt and you have these huge medical bills, you can use that money, but you want that just to keep growing, and then just use the regular high yield savings account for any unexpected surprises that are a little bit smaller amount. The bottom line is, doesn't matter your age, you can do it. Yes, I used the age of 45. That's when I really started to improve my financial journey. You can do it as long as you stay consistent. Even when the market is not looking so great, you don't sell. You reinvest your dividends and you add money consistently. If you're ready to start your investment journey, drop a money bag emoji down in the comments. And if you want to learn more about the 40-40-20 split, watch this video next. I think it will be very informative for you. If you watch to the very end, thank you so much. Henry and I really do appreciate it. Until next time, bye.